So let's go over this example, the problem very quickly together. The parent firm is a US-based firm, and the subsidiary is in Britain. The parent paid 25 million, which equal to the subsidiary's fair value, and they use the equity method. And then we have the firm's balance sheet at January 1st, 2014. 2.3 million excess fair value over book value, that is in Great British pound. And then this is 2 years later, on December 31st, 2015, we have the firm's trial balance. And also we know that the firm generates net income of 1.1 million Great British pound in 2014, declared paid no dividend, and then no inter-entity transaction dividend. However, the next year, in the year 2015, the firm paid out dividend. And then we also know the relevant exchange rate. Okay, so this is what we know. And also we know the functional currency is the subsidiary's local currency. So now can you tell me which method? Is it the current rate method or temporal method the firm should use? So this is the local currency and reporting currency. And functional currency equals to the local currency. So we don't need the temporal method. The method that needs to be used is the current rate method. And now let's look at the worksheet. So if you go on Island, you should see a blank worksheet. Sorry. So you should see a blank worksheet there. So please take maybe 15 minutes, try to work on this example on your own first, and you can pause your video for now. Okay. So the first step here is to translate the foreign subsidiaries trial balance into US dollar. And then because now we know the firm should use the current rate method. So under the current rate method, all of the assets and liabilities should be applied the current rate. So cash is an asset, account receivable is asset, inventory is an asset, PP&E is asset, account payable is liability, long-term debt is not liability. And then common stock, that's an equity account. So we apply the historic rate. And for all of the sale income statement account, we apply the average rate. So except dividend is an equity account, we apply the historic rate. So let's just do the translation first. Current rate is 1.53. Historic rate, when the firm first issued its stock, that was when it was first established. That was on January 1st, 2014. So the exchange rate is 1.51. And the average rate during the year 2015 is 1.55. Historic rate when the dividend was paid on June 30th, 2015. So the historic rate on that date is 1.58. So let's first calculate these items. And then let's figure out this retained earning. So this retained earning amount, so I already revised it here. It is actually at the beginning of the year for the firm. Retained earning So how should they be translated? What is the equivalent US amount of this beginning retained earning? This is the beginning of the year for 2015. So in order to figure out the equivalent US dollar amount of this beginning retained earning, we should actually try to figure it out using the firm's beginning retained earning in 2014, changing retained earning, and then we're going to get to the ending retained earning. So in the year 2014, the firm's beginning retained earning, which is January 1st, 2014, in Great British Pound, it is 2.7 million. And then the firm has net income during the year of 1.1 million. The firm doesn't have any dividend. So the ending retained earning for the year 2014 is 3.8 million. So this is how we get this amount in Great British Pound. And then the beginning of the year retained earning is the historic rate because that was when the firm was just established. Oh, sorry, that was when the firm was just acquired. And then during the year, net income is applied the average rate. So 1.51 and 1.52. So the ending retained earning in US dollars is 5.771 million. So here retained earning 5.771 million. So the point here is retained earning is not something like we just apply a rate. It needs to be calculated because that is the result of the beginning retained earning and net income. And they are usually applied a different rate, like net income is applied the average rate. And if we have paid out, if the firm paid out dividend, we should apply the historic rate to dividend, the historic rate at whenever the dividend was paid out. So that's why for the ending, when we translate retained earning, it is usually the result of all of those. So just like what we covered in last class, we need to work through the statement of retained earning first. So to get ending retained earning, and we cannot just simply apply a rate to the foreign currency to get its US dollar amount. This is not what we do. So after we have figured out all of the items on the trial balance, the trial balance should balance, but here it's actually not. So in order for it to balance, we need to decrease this by 301.5 thousand. And this amount is cumulative translation adjustment. So this is step one, to translate foreign subsidiaries trial balance under the foreign currency to the US dollar. And then determine of the balance of the firm's investment account. So what's journal entry? Now in this situation, the firm is using the equity method and current rate method. So we need to make some journal entries. So in order to figure out the firm's journal entry, the firm actually needs to make a journal entry in the year 2014 and then in the year 2015. In the year 2014, so in the year 2014, the journal entry is to debit investment. So, well, yeah, let me first go through the numbers here. So this journal entry is basically to record the translation adjustment, the cumulative translation adjustment. And how much amount should we record? So this is actually if we have gone through, so in order to figure out the amount, we need to have gone through the trial balance for the year 2014. So the same thing, and this trial balance is for the year 2015, the same thing. So, and now we don't have the trial balance for the year 2014. However, even without that, we can kind of figure out those numbers, because if you still remember, we have that formula of changing net asset equals to the change in common stock plus changing additional paid-in capital plus net income minus dividend, right? So in the year 2014, changing net asset. So what is the amount? The ending net asset of the firm is 23,800. It's actually 23.8 million. And then the beginning net asset is 22.7 million. So all of this, you can get it just directly from the example that was given. Yeah, so all of those information are given. And then the common stock doesn't change. Additional paid-in capital doesn't change. The firm's net income during the year is 1.1 million. And then there's no dividend. So for the ending net asset, we need to apply the current rate at the end of the year 2014, which is 1.56. For the beginning net asset for the year 2014, we need to apply the beginning current rate, beginning exchange rate for the year 2014, which is 1.51. And then for net income, we need to apply the current rate, which is, we need to apply the average rate during the year 2014, which is 1.54. So as you can calculate here, so this gives us 37,128,000, and this gives us 34,277,000. This is, and this, so this is in US dollar, and under US dollar, this equation won't balance. In order for it to balance, we need to add another 1.157 thousand. So yeah, so this is basically, so, and then this side is the equity side, which means that we need to increase the equity account by 1.157 million. In order to increase your equity account by this amount, so this is actually the cumulative translation adjustment recognized in the year 2014. So on the parent's book, we need to increase the investment account and credit cumulative translation adjustment for the same amount. And then in the year 2015, so for cumulative translation adjustment, we already have this amount in the year 2014. So in the year 2015, we just need to increase it by whatever amount to make the new equation balance. So let's just do the same thing for the year 2015. For the year 2015, now the ending net asset is 27 million. The beginning net asset is 23.8 million. Common stock doesn't change. Additional paid-in capital doesn't change. Net income is 3.95 million. Dividend is 750,000. And then we apply the different. So 1.53 is the current rate at the end of the year, and 1.56 is the current rate at the beginning of the year. The average rate during the year is 1.55. And the dividend, when the dividend was paid out, its historic rate is 1.58. So, and then we get different numbers. Okay, so now under the US dollar, this inflation doesn't balance. So in order for it to balance, in order for it to balance, we need to take out 755.5 thousand. And this should be a decrease in the firm's equity account. And then, which means that we need to debit over the 2 years. So what is the ending balance for cumulative translation adjustment at the end of the year 2015? So that would be 1.157 million minus 755.5 thousand. So that will give us 401.5 thousand. And this amount is exactly this amount, the amount that is on the firm's balance sheet, because this amount is the cumulative amount. And the journal entry we make is the change in that amount, that caused the change in that amount. And then the parent's investment account balance under the equity method. So let's look at what is the, under the Great British Pound and under the US dollars, the original value is 25 million investment in Great British Pound. And then the 2014, the firm's net income is 1.1 million. The firm doesn't have any dividend during the year. So, and then 2015 net income is 3.95 thousand, and 2015 dividend is 750,000. So the original value is translated using the historic rate, which is 1.51. Net income is translated using the average rate, 1.54. And then dividend is translated using the historic rate, 1.58. And also the for the firm's investment account, so those are the general entries we talked about before. However, if the firm is using the current rate method and under the equity method, it is going to make this two, the parent needs to make these two additional journal entries. In the year 2014, the impact of this journal entry will increase the firm's investment account by 1.157 million. So the translation adjustment in the year 2014 is 1.157 million. And the translation adjustment in the year 2015 is negative 755 3.5 thousand. So the balance of the firm's investment account is 44. Sorry, it's a little bit slow in reacting. 44.783 thousand. So that's the firm's investment account balance at the end of year 2015. And this is how this number comes about. So let's just go over again how this number is coming from. That's 25 million initial investment using the exchange rate at the time, which is the historic rate, plus 1.1 million using, so that is net income for the first year, and we're using the average rate for the year, plus 3.95 million multiplied by the average rate for the second year, minus 750,000, that is the dividend. And then we take 401.5 thousand, that is cumulative translation adjustment over the 2 years, the combination of the 2 years. So when we do consolidation, and then when we do consolidation, we have the parent firm, and for the subsidiaries firm, we need to take it from the last column here. So the amount after translation. So let me just put in the number for you here. This just copies from your first page. Okay, so and then for the consolidation, and next we need to do the consolidation entries. Of consolidation entry S, the purpose is to eliminate subsidiaries shareholders equity account. So we need to eliminate common stock and eliminate the beginning retained earning. At the same time, decrease the investment account. Consolidation entry A, the difference is to mark up book value to fair value. So we know that the original difference between fair and book value at the time of acquisition is 23 million in Great British pounds. And then we use the historic rate here. So that will give us 3.373 million. It's 3.473 million. So one thing I need to mention is, and I'm going to kind of go over it again in a minute, is here the reason we're using historic rate is because this amount is kind of included in the initial investment. And for the initial investment, we use the historic rate. So if we don't use historic rate here, your investment account won't go to zero after consolidation. That's why we need to use the historic rate in our consolidation entry A. And consolidation entry I, the purpose is to eliminate the equity income recognized by the parent. So which is 6122.5. Consolidation entry D, the purpose is to eliminate the dividend paid out by the subsidiary to the parent. Sorry, it's being a little bit slow. And at the same time, investment account goes up by the same amount. Consolidation entry T. So the purpose is actually T is a new account. The purpose is just to eliminate, to reverse. Actually, maybe we can just look at here. So if you can see here, cumulative translation adjustment is kind of double counted here when the parent is using the equity method. So we just need to eliminate this double counting. And then finally, consolidation entry E2. So for E2, what we do is the difference between fair and book value is 2.3 million. And we multiply it by the difference of the current rate at the end of the year 2015, which is 1.53. And the original rate, when the historic rate, when this this subsidiary was first acquired. So we take the difference between these two, and this will give us 46,000. So we mark up the equipment by another 46,000. And oh sorry, we mark up this PP&E. And then cumulative translation adjustment decreased by 46,000. So this is what we do here. And why is consolidation entry E2? Why do we need to take the difference between fair and book value and then multiply it by the change in exchange rate to get consolidation entry E2? So actually the purpose here, well, so let me just finish calculating the last column and then I will go back to talk again about this E2 entry. So consolidated totals, we just do the same thing as what we did before in all of the consolidation entries, just add up things horizontally. And for some of the items, we need to add them up vertically. And then we add up everything that will give us everything, you're going to get on the balance sheet. Sorry. And then your investment account should go to 0. Your PP&E will add up to 69,335. And then all of the assets will add up to your CTA will go to, and then all of the liabilities and equities will go to this. It should be equal to your total asset. So now let me talk about this E2 entry. This E2 entry, the reason we have this E2 entry is because if you look at the firm is using the current rate method. So on the subsidiaries book, its PP&E is translated using the current rate. However, this amount in the A entry, it is translated using the historic rate. Why do we need to do this? As we just mentioned, because if we don't use the historic rate here, your investment account won't go to 0. And then so there's a difference in rate, right? We are using the current rate method, so we should have been using the current rate for the consolidated total number. So in order for this to make up for this entry, the entry A, we need to make an additional journal entry, which is the entry E2, to make up for the difference between the current rate and the historic rate. So just this is on the parent book, all of it as a PP&E are translated using 1.53. So here it doesn't make sense. So if we use 1.51, there's an inconsistency here, meaning some of the PP&E are translated using 1.53, while the difference between fair and book value, that amount of the value of the PP&E are translated using 1.51. So it doesn't make sense here. So we need to, for that value, we need to make up the difference between the current rate and the historic rate, so that the ending consolidated number, it is consistently that we're using the current rate. So this is just the purpose of this E2 entry. This is what is happening here. Yeah. So yeah, I think that's it, right? So this kind of explains all of the consolidation entries, all of the additional consolidation entries T and E2. So and that's all for today's class.